The Federal Reserve cut rates last week, just a quarter point, and while that won't help most Americans suddenly qualify for a mortgage, the story is different in commercial real estate. Since the Fed started hiking rates in 2022, CRE values dropped in certain property types, sales activity tanked, and banks largely sat on the sidelines when it came to lending. The market essentially froze in 2023. Now, analysts say the easing cycle could provide much needed relief. Unlike most residential mortgages, a big chunk of commercial loans are tied to shorter term and floating rate debt, making them more sensitive to Fed moves. I've seen a gradual uptick in activity in shopping center investment sales in Texas over the past 18 months, and we project increased activity with lower borrowing costs unlocking more deals. Plus, fatigue of investors sitting on the sidelines so long. In our markets, the lack of inventory is the bigger problem. But it's not all green lights. Inflation remains sticky above the Fed's 2% target, the job market is slowing, and tariffs could continue to push up construction costs. One standout segment is data centers, which continue to be the fastest growing sector nationwide, driven by AI demand. So the Fed may be giving us cheaper short-term money, but between inflation risks, the 10-year yield, and sector-specific challenges, the CRE recovery is still far from guaranteed.